The information in this presentation is for you if you are a member of the CAAT pension plan who works for Torstar, and you are eligible for the voluntary departure program your employer is offering. Today we'll be talking about your pension and how it will be impacted by the program if you choose to apply for it. The goal of this session is for you to understand your pension and how it works, so that you can make an informed decision. This will be our agenda for the session. We'll start by talking about what happens to your pension. Then, we'll take a look at your pension options under this program. Next, an example of the options you can expect to have, followed by a discussion on some of the things that you can consider that can help you make this decision. And finally, we'll look at the resources that are available to you in case you have further questions. So let's start by talking about what happens to your pension. We'll begin with some basics. What exactly is a pension? Well, essentially, a pension is a lifetime of income after you retire. It's like continuing to get a monthly paycheck even after you stop working. How does the pension plan work? During your working career, you've been making contributions to your pension. Your employer has also been making contributions. These contributions go towards building your pension. As you've continued working and making contributions, your pension has been growing. The longer you work, the more your pension grows. When you retire, you start getting pension payments on the first day of every month. Your pension continues to be paid to you each month for as long as you live. It doesn't matter how long you live, your pension will still be there. You can never outlive it. Your pension includes valuable features. The first is inflation protection. It's sometimes called indexation or COLA. Inflation is the tendency of items to increase in price over time. Inflation protection increases are increases to your pension once you've started to collect it. On January 1st, in each year of retirement, you can expect to receive an increase to your pension. There's nothing you have to do. You don't have to apply for it or call us. We will apply the increase automatically. And once you receive an increase to your pension, it can never be taken away. It becomes part of your guaranteed base pension, and the next year's increase is just added on top of it. This graph shows the impact of these inflation protection increases over a period of time and how valuable they are. The example shows a member retiring in 2020 with an annual lifetime pension of $20,000. If this person was part of a defined benefit pension plan that did not have inflation protection, their pension would follow the blue straight line on the bottom. They would receive the same amount of pension each year in retirement for as long as they live. As a member of the CAAT pension plan, you can expect your pension to follow the green line, which increases over time to reflect the inflation protection that is applied to it. So in this example, the member starts with an annual pension of $20,000. After 35 years of being retired, they can expect their pension to have grown by 157%. You can really see the impact of these increases over time. You'll notice that there's a bit of a kink in the green line. The first part of the line increases at a slower rate than the second part. This is because if you're retired between now and 2027, you'll receive an inflation increase of 25% of the Consumer Price Index, or CPI. Starting January 1st, 2028, that increase will go up to 75% of the CPI, and it will stay at 75% forever. Your pension also has survivor benefits. If you pass away in retirement, your spouse will receive a portion of your pension paid to them each and every month for as long as they live. That survivor pension is also increased for inflation protection. So, to summarize, what happens to your pension overall? You'll receive a pension payment when you retire, each and every month for as long as you live. Your pension will grow in retirement with inflation protection increases. If you pass away, your spouse will receive a portion of your pension for as long as they live. And the survivor benefit also receives inflation protection increases. Now let's take a look at your pension options under the Voluntary Departure Program. If you do not apply for the VDP, you simply keep working. If you apply for the VDP and are approved, then your last day worked will be the date indicated on the VDP estimate that you received from your employer. You will receive a VDP payment, which will be paid through salary continuance until a specified date. Your salary continuance end date will be individual to you and is also indicated on your VDP estimate. This means that you will continue to be paid by your employer through your regular payroll during the salary continuance period, as if you were still working. During this time, your pension will grow, and it will grow in two ways. First, because you'll be making contributions on your VDP payments, and your employer will match your contributions dollar for dollar. And second, it will grow because you're waiting to start collecting it. Once you reach the end of your salary continuance, you'll have some options. What those options are will depend on your retirement eligibility. Retirement eligibility simply means, can you start collecting your pension? Age 50 is the threshold. If you are age 50 or older, you are retirement eligible. That means you can start collecting your pension right away. If you are under age 50, it means that you can start your pension at a later date, anywhere between age 50 and age 65. There is flexibility in retirement dates in the CAAT pension plan, so remember that you can choose the best time to retire for you. Age 65 is called your normal retirement date. This is the date at which anyone in the plan can retire with an unreduced pension. If you retire before age 65, that's called an early retirement. If you retire early, your pension may be reduced. If you retire after age 65, that's called a late retirement. Let's look at an example now, which will help you see what options you'll have for your pension. Let's take a look at Philip. If Philip decides to apply for the VDP and gets approved, his last day worked will be December 31st, 2019. He'll then go on salary continuance until November 16th, 2020. At the end of his salary continuance, Philip will be 58 years old. Therefore, he is retirement eligible since he's over age 50. Philip's last day worked is December 31st, 2019. From his last day worked up to the end of his salary continuance, Philip's pension will grow as he continues to make contributions on his VDP payments. At the end of the salary continuance, on November 16th, 2020, his pension contributions stop. Philip will now have a couple of options. First, since he is retirement eligible at the end of his salary continuance, he can start collecting his pension right away. If Philip chooses this first option, he will receive his first pension payment on December 1st, 2020. He will then continue receiving a pension payment each and every month for as long as he lives. Keep in mind that if you choose option 1 and you are under age 65, your DBplus benefit will be reduced and your Torstar benefit may be reduced. The reduction on your Torstar benefit would be specific to your Torstar plan and the date at which you start collecting your pension. Philip's other option is to defer his pension to age 65. To defer your pension is to wait to start collecting it. If Philip defers his pension to age 65, it will be higher at that date than if he had started collecting it right away. It won't grow because he is making contributions, but because he will wait to start collecting it. Philip can also choose to start his pension at any date between the end of his salary continuance and age 65. Again, if he does this, his pension may be reduced. So, now that Philip knows what his options are, he's going to want to know how much pension he can expect at each date before he can make a decision. Both of Philip's options are displayed here on the graph. The blue, or bottom line, represents option 1, an immediate pension. Under option 1, Philip will receive an annual pension of $23,064. This means that if Philip chooses option 1, he will start collecting a monthly pension of $1,922 on December 1st, 2020. That pension will increase on January 1st of every year for as long as Philip lives, with inflation protection increases. The green, or top line, represents option 2, a deferred pension starting at age 65. Under option 2, Philip will receive an annual pension of $27,500. If Philip chooses option 2, he'll start collecting a monthly pension of $2,291 on November 1st, 2027, which is his age 65 retirement date. Again, that pension will increase on January 1st of every year. Now, under the second option, Philip won't receive any pension payments until November 1st, 2027. But in the meantime, his pension will still be growing. The dotted gray line just before the green line shows how the pension grows in the deferral period. Now let's talk about what to think about when making your decision. First, review the BDP estimate you received from your employer and take a look at your pension estimate if you've received one. If you have received a pension estimate and you're under age 65 at your salary continuance end date, you'll find on page 1 your estimated pension at 2 key pension start dates. First, your pension if you start collecting it at the end of your salary continuance period. And second, your pension if you wait to start collecting it until you reach age 65. If you're over age 65 at your salary continuance end date, you'll find on page 1 your pension if you start collecting it at the end of your salary continuance period. Keep in mind, you will have other options available to you upon retirement, including the pop-up option if you're eligible for it. The estimate you received just shows your pension under the normal form only. Now you can also run a pension estimate for yourself using our online pension estimator tool. I'll be going through a demo of the tool today. Next, you'll want to think about whether you're ready to stop working. If so, then this BDP may have come at the right time for you. If not, then you may want to continue working. Think about your total retirement income and decide whether this is enough for your retirement. Remember to include any other sources of income you may have, such as your government pensions, which are the Canada Pension Plan, CPP, and Old Age Security, OAS. Maybe you have RRSPs or have earned a pension through a previous employer's pension plan. The combination of all these sources of income will provide you with your total income in retirement. This decision is a very personal one and only one that you can make. It's an important financial decision, so you may want to get the advice of an independent financial advisor. If you haven't already requested a pension estimate from your HR, then you'll want to run an estimate for yourself using our online pension estimator. The tool is found on our website at www.dbplus.ca. On this page, you'll want to click on My Workplace Offers DBplus. In the gray header, click on Estimate Your Pension. You'll start by selecting your employer. We ask that you read through the terms of use, click Agree, and now you're ready to start your estimate. You'll begin by inputting your date of birth. To more easily scroll through the years, you can click on the date at the top and even again on the year. Find your year of birth, then the month, and then date. Select the Torstar pension plan which you were previously in, and then click Next. You can use your latest annual statement to find your annual replicated pension. Select your last statement date, and then input your accrued DBplus benefit, which will also be on your statement. Now, enter your pensionable earnings. The definition of pensionable earnings differs depending on the Torstar plan you were in, so if you're unsure, contact your HR department to see what your pensionable earnings are. For the earnings increase here, select 0, and finally enter your continuous service, which is also on your VDP estimate. Click Estimate. The result here is your estimated annual pension at age 65. This assumes that you will continue working up until age 65. So if this person chooses not to take the VDP and keeps working until age 65, they will have earned an annual pension of $25,329. Now, what if this person is applying for the VDP package? To find out their immediate pension amount, or the amount that they would receive starting at the end of their salary continuance, we'll scroll down a bit, and on the left side, under Retirement Assumptions, we'll change the retirement date. If your salary continuance end date is mid-month, then you'll use the last day of that month as the retirement date. Refer to your VDP estimate to find your salary continuance end date. This is the date you'll run your estimate for in the tool. Remember to scroll down and click Calculate. Now we have this member's immediate pension amount at the end of their salary continuance. If this person elects an immediate pension, they will start receiving an annual pension of $14,070. The pension will be a combination of the Torstar benefit in blue and the DBplus benefit in green. You can scroll down and expand on the Detailed Explanation tab to get even more information on the calculation. Now, the estimator will provide you with your starting pension amount. It does not include any inflation increases yet. So, once you retire and you begin collecting your pension, you will receive inflation increases on top of that starting pension amount. Please also remember that this estimator assumes that you do not have a spouse. If you do have a spouse, then your actual pension amount will differ, as the Torstar benefit needs to be adjusted to account for the survivor benefit. The DBplus piece has the 60% survivor benefit built in already at no cost to you, and so it will not change greatly from the estimate. So let's go back to the presentation now and look at some other considerations. If you have optional ancillary contributions, your OAC options will be provided to you after retirement. Next, you may want to consider a pension purchase. A pension purchase is a way for you to maximize your retirement income. If you have a period of employment prior to enrolling in the pension plan, you may be eligible to purchase this period. If you have a period of employment where you participated in another Canadian registered pension plan, you may be eligible to purchase this period. If you decide to purchase pension, the process must be completed by the end of your salary continuance. I mentioned that it's important to factor in all of your sources of income in retirement when deciding whether you have enough income for your retirement. So let's take a look at how your government pensions will work. Canada Pension Plan, or CPP, is the national pension plan that you have been paying into throughout your entire working career. It provides you with a lifetime pension based on your total earnings history. CPP starts at the age of 65 on an unreduced basis. However, you can start CPP early as age 60. If you do take an early CPP, your benefit will be reduced by 7.2% for each year that you are under age 65. So, if you start your CPP as early as possible, at age 60, the reduction to your benefit will be 36%, and that reduction is permanent. You can also choose to delay your CPP benefit past age 65 as far as age 70. In that case, it will be increased by 8.4% per year after age 65 up to age 70. As I mentioned, the amount of CPP you will receive is based on your total earnings history. The government will take an average of all of your earnings and multiply that by about 25%. The maximum CPP for this year is $13,855 per year. However, the average amount is about $7,900. Only about 50% of Canadians are at the maximum. Old Age Security, or OAS, is not a pension plan, but rather it's a payment from government revenues, or tax dollars, and eligibility is based upon how long you've been living in Canada. With OAS, there's no early start option. It starts at age 65 on an unreduced basis. If you want to delay the start of OAS, you can do so up to age 70. And if you do, the OAS amount is increased by 7.2% per year you are from age 65 up to age 70. To be eligible for OAS, you have to have been living in Canada for at least 10 years after the age of 18. The maximum OAS is $7,362 per year as of the fourth quarter of 2019. Essentially, if you've been living in Canada for at least 40 years after the age of 18, and you're living in Canada for the 10 years immediately preceding the approval of your OAS pension, you'll most likely be eligible for the maximum OAS. Remember that your pension is taxable. In retirement, you also have to complete your taxes like you do every year now. Currently, you get a T4 from your employer. When you retire, you'll receive a T4A from us. You use it in the same way you use your T4 to complete your taxes. There are multiple tools online which you can use to get an estimate of your net income after taxes. For example, the CRA website has a payroll deductions online calculator. You can also visit simpletax.ca and use a similar tool. Finally, let's look at your next steps. If you have any questions, you can reach out to HR services at your employer. You have until December 20th to apply for the VDP. So remember to submit your application by this date if you'd like to take the package. If you choose to apply and you move anytime between now and the end of your salary continuance, please let HR services know so that your pension options package is sent to the right place. You don't have to decide now which pension option you want to take. You have until the end of your salary continuance to decide. You'll receive your pension options package at that time, which is when you can make your decision. So, where can you go with further questions? We're doing 2 in-person information sessions and this webinar. We'll be holding one-on-one meetings with those who are interested after the in-person sessions. Also, remember that you can reach out to your HR even if you've applied for and been approved for the VDP and have gone on salary continuance. Just because you've stopped working for your employer doesn't mean you can't reach out to HR. They're still there to help you. A recording of this webinar will be available to you as well. This concludes the presentation. Thank you.